Piran Engineer, Senior Research Analyst at CLSA India, joining us this morning. Piran, it's wonderful having you. An opportune time as well. In fact, we were in conversation with Sridhar Sivarab just a couple of days back. And, his views are quite vocal and quite public as well. But I wonder what your take on his view is, right? He's suggesting that the market share losses in private sector banks is a concern. And second, what he's also saying is profitability for the sector as a whole could be a concern. I wonder what your take is on that specifically.
Sure. So firstly, thanks for having me over.
Great having you.
On the market share loss bit, I think it's a temporary thing. Last 2 years, private sector banks have lost some market share to PSU banks. It's also a function of PSU banks having a lot of excess liquidity on the balance sheet, which they've redeployed into loans. Whereas deposit growth, they continue to lose market share. The second reason is HDFC Bank in FY25 went slow on growth due to LDR concerns. These two things combined resulted in PSU banks growing faster than private sector banks. I think this is not a structural thing. In fact, in 1Q FY27, private sector banks grew faster on a sequential basis than PSU banks. So that reversal has started from 1Q. On your second question on whether profitability has bottomed, I don't really think so. In fact, if you look at the ROAs of most banks, they've been largely intact as they were a couple of quarters back. What we're seeing right now is NIMs for banks are declining, or NIMs for some banks are declining, but that's being offset by lower OPEX, lower credit costs. So the ROA profile by and large for banks has not really deteriorated.
Quite interesting you say that. So, if you were to just analyze this a little bit more, given all of this, Piran, just wanted to understand where is it that you stand on the whole PSU banks versus private banks, debate right now, and if at all your preference has shifted from what it was about a year back?
So for me, it will be privates over PSUs as a cohort. Of course, within each cohort, there are certain, companies that we like and don't like much, but privates over PSUs, simply because of the fact that I just told you that, market share gains are accelerating. The valuation gap between the two cohorts is at, probably multi-year lows. And that's why I think it's a good time to look at or relook at private sector banks. The other thing is private sector banks have also been, if I call it victims of FII selling over the last 5 years, and that has also led to their multiples getting derated. As and when FIIs come back to the market, you should see that pressure also go away.
Piran, I wonder, so the entire loan growth, right, and how it's playing out, and you've suggested in your note, and fairly so, that H2 FY27 is when margins start to recover, right? But loan growth is coming from corporate. Deposit growth momentum at lower kind of cost of deposits is also proving to be difficult. Some banks have found it tough. Does this basically hurt the thesis there that H2 FY27 there could be a margin recovery? I'm trying to get your perspective of what you're seeing on ground.
No, so what I said in my note is that from H2, the base becomes easier. Because right now you're comparing it to margins a year back, which was when the rate cut just started. So margins were higher. After the rate cuts, obviously margins have settled lower. But by H2, margins were already low. So the base becomes easier. That's what we had written in our note. Look, on your NIM thing, I think the way, at least I think about it, not many investors do actually, is that corporate loan growth right now is opportunistic. You've had increased working capital demand due to the Gulf War. You've had some migration from bond market borrowings towards bank borrowings. So when banks have this demand, why will they not cater to it? Let it come at lower NIMs, but it's adding to your profits, your absolute profits, your EPS is going up if they cater to this demand. That's point number one. Point number two, some banks still have a lagged impact of deposit repricing remaining, and that should drive cost of deposits improving over the next couple of quarters. For example, HDFC Bank, 30% of their term deposits are yet to mature. They were raised before March 2025 at higher deposit rates. Today, deposit rates are 50, 60 bits lower, and that should help NIMs. Now, that's 30% for HDFC. That could vary across banks. Some banks, it's almost done. Some banks still have it left. That's how I'd put it.
Okay. So you're confident about this timing of second half of FY27, is it?
Yes.
Okay,
Absolutely.
good to hear. Okay, good to hear that. The other thing also is, Piran, just to the point that you were earlier flagging off about private banks steadily losing market share to PSBs. What I wanted to understand was if that is a cyclical phenomena, or does it seem like it's a funding cost-driven phenomena, and whether it could reverse at any point?
No, in fact, it has started reversing. I think it was a phenomenon that, look, PSU banks were sitting on a lot of excess liquidity. Let's look at things on a decadal scale. From 2015 to 2020 or 2019, there are a lot of corporate asset quality issues. So while their deposits kept growing, they were reluctant to lend out. Then you had COVID. Again, that was a problem for the whole sector where due to infusion of liquidity in the system, deposits were there, but credit was weak. Now, from 2022, PSU banks were sitting on LCRs north of 150%. In simple words, a lot of excess liquidity. Today, they're sitting at an LCR of about 125%. So they've redeployed 25, 30 percentage points of LCR over the last 4 or 5 years. That has helped them grow loans faster than deposits. Then on the deposit front, PSU banks are still losing market share. And therefore, at some point when your liquidity normalizes, which according to us will happen in a couple of quarters, your loan growth will match your deposit growth. So they'll again start losing market share on loans. Therefore, just to conclude, according to us, it was a cyclical phenomenon and will reverse in FY27.
Okay, so FY27 is when it reverses,
Yes.
right?
In fact, on a sequential basis, it's already started to reverse in 1Q.
Perfect. And the lever for that, Piran, what do you think? It's just liquidity? That's what it is?
And deposit growth.
And deposit growth.
Private sector banks continue to grow faster on deposits.
Correct. I also am curious to know, Piran, that there's a cycle shift which has happened, especially in the mid and the small banks. Now, maybe small, I'm not so sure how much you cover, but mid you do, I know that. Do you believe risk reward there looks better? Just the fact that the clip of growth may be faster, there is a re-rating as well on the cards. Do you believe that some of those will continue to play out, or are you more sanguine?
No, in fact, I agree with the former. The clip of growth would be faster, and you're recovering from your asset quality issues that were there in FY25, 26. But the re-rating has happened. In fact, this quarter we downgraded quite a few mid-cap banks, particularly on the fact that re-rating has happened and valuations vis-a-vis large caps are at levels we don't comprehend.
But Piran, tell me, I mean, where does it really sit on CLSA's broader house call, right? Because you've been fairly muted on Indian equities, and now you're very bullish on banks. The two doesn't sort of equate.
No, so look, I mean, at CLSA, each analyst has his or her own view, and we don't really go by a particular house call. So I'd leave it to my strategist to share his view on the overall markets. But when it comes to banks, look, I don't think there are many sectors that offer a 2-3 year window of mid-teens earnings growth and with valuations at PEs of low double digits. I can't think of any other large sector in India that offers that.
Well, may banks play the magic for the overall index as well. That's all I can say. But Piran, if you had to pick out that one bank across categories, right, and across the cohorts, which one would it be where you find the risk reward and growth all most suitable from an investment perspective?
It'll be HDFC and SBI. If I were prodded to pick one of the two, probably an HDFC, simply because at the moment it's so out of favor. I think there are a lot of, there's a lot of negativity around the stock, some for, valid reasons like concerns on corporate governance, the chairman's exit, etc. But some for just due to perceptions. Like one perception is, oh, they're not able to raise deposits. That's actually not true. They've done well on CASA growth compared to even the good private sector banks over the last 1 year, 3 years. They've done an excellent job on cost control that's gone absolutely unnoticed. And their asset quality continues to improve despite, of a very normal base. I think some of the things are being ignored out here. 6 months back, there was a lot of talk on LDR. Nobody had any other questions apart from LDR. The narrative is slowly changing. I just think that there is just so much noise and so much negativity in the name that a couple of positives could really re-rate this stock big time.
Wonderfully put. Piran, last off, we're starting to see good growth come in, right? Albeit doesn't matter whether it's corporate or otherwise. Do you believe that growth can translate to EPS growth as well in FY27, just given everything that we've just spoken about?
Yeah, absolutely. So look, I'll put it in numbers. Last quarter, NII growth for our coverage universe was 6%. This quarter, it's 9% YOY. Last quarter, core PPOP growth was in low double digits. This quarter, it's 18%. As the base gets easier to that extent, your EPS growth would pick up. I think that's already started this quarter.
And specifically with regard to HDFC Bank, just on the EPS front, do you believe that FY27 is that inflection year or FY28?
27.
27.
Because loan growth has started picking up.
Correct.
NIM should improve a bit, and asset quality improving will also give you an EPS kicker.
Exactly. Perfect. Piran, wonderful talking. We could go on,
Likewise.
but timed out on this one. Thank you so much, though, for coming.
Sure.
Really appreciate it.
Thank you.